Lesson 3. The only constant in the modern world is change. Many of today's top jobs and companies didn't exist a mere few years ago. 2 short decades ago, there was no Facebook, and Amazon and Google were still small niche companies. With the accelerating changes in the world economy, one needs to be forward-thinking when planning and starting a business. The future may be unpredictable, but there are some ways to make good predictions. One way is through business and accounting. Business and accounting play a critical role in building the financial foundation your company needs to grow and thrive in a sustainable manner. Today, we'll dive into a range of topics, including the language of bookkeeping, reporting loss and profit in income statements, the value of balance sheets, cash flows and cash flow statement, controlling costs and budgeting, working with and understanding the tax man. We know most people don't like this part of a business, but it is the law, and knowing how it works can save you some headaches in the future. The language of bookkeeping. Bookkeeping refers to how you track finance, and anyone in business learns its importance. As you dive into this area of your business, it's important to learn some of the essential terminology, even if you're not an accountant. You need to know some of the key terms, such as balance sheet, a financial statement that presents a snapshot of your company's financial position. Assets, everything you need to run the business successfully, like tools and inventory. Equity, the money invested in your company by the owners. Income statement, a financial statement presenting a summary of your business's financial activity over a month, quarter, or year. Revenue, the money you've collected in the process of selling your company's goods and services. Cash basis or accrual accounting. Before beginning to record transactions, decide between using cash basis or accrual accounting. With cash basis accounting, you record all transactions in the books when cash is exchanged. With accrual accounting, a store sells products on store credits and bills the customer at a later date. Both have their pros and cons. Differentiating debits and credits. Debits and credits are simple terms, but it's important to know the exact difference. These impact your accounts in different ways. Debits increase as credits decrease, and vice versa. Think of a debit as a minus and a credit as a plus. Tracking your income statement accounts. Income statements are made up of 2 account types. Revenue, which tracks all money coming into the business and methods used to generate income. Expenses. These accounts track all money that a business spends in a year, be it investments or other purchases needed to stay afloat. Setting up your chart of accounts. A key step is to set up your business's chart of accounts, a list of accounts that apply to your business. Don't spend too much time worrying if you can't name every account you may need. You can add accounts in the future. To profit, it's essential to report in income statements any losses and profits. A business profits primarily in 3 ways: selling products, selling services, investing in assets that generate income. Deconstructing profit. You know what a profit is, but you may not know the full definition. A profit consists of more than just a dollar sign. In simplest terms, a profit is your revenue minus your expenses. Profit is associated with cash. Just as all roads lead to Rome, your expenses and revenue will lead to cash. However, other assets and liabilities are recorded to show the free flow of profit. These include making sales, selling products, prepaying operating costs, fixed assets, and unpaid expenses. Often, businesses report unusual gains and losses in addition to their usual revenue and expenses. An unusual gain or loss is when you gain or lose profit in a way that is not normal for your business. For example, an unusual loss would be if your business had to shut down for a few days due to extreme weather. An unusual gain may involve an event that brings more tourism to your area than usual. Remember that recording a gain increases an asset or decreases a liability, and vice versa for recording a loss. Balance sheets help track your assets and liabilities clearly. Look at the visuals on screen for an idea of how to write a proper balance sheet. Balance sheets usually highlight categories like your assets, liabilities, and owner's equity. Judging liquidity and solvency. It's important to ensure that your business dealings are solvent. Solvency refers to the ability of a business to pay its debts on the agreed date. Delayed payments on debts can cause serious problems for a business. In small cases, your business may have to pay interest. In extreme cases, a business can declare bankruptcy, where a business seeks help from a court to relieve them of their debts. Few businesses can recover from bankruptcy. The liquidity of a business has multiple definitions. Generally speaking, liquidity refers to the ability of a business to keep its cash balance and its cash flows at adequate levels so that operations aren't disrupted by cash shortages. Sizing up assets and liabilities. Evaluate where you are in terms of assets versus liabilities. Compare the amount of your company's sales revenue with its balance sheet accounts. The size of a company's annual revenue will determine whether a company is able to operate profitably. Financial backing or capital is essential to run any business. In overview, a business raises capital needed for its assets by buying goods or services on credit, waiting to pay some debts, borrowing money, getting owners to invest money in the business, and making any retained profit. Borrowed money is known as debt. Capital invested in the business by its owners and retained profits are two main equity sources. Cash flows and cash flow statement. How do you meet your cash flow statement? It's simple. Revenue minus your expenses equals profit or net income. Product businesses typically generate negative cash flow from investing activities, which means they spend more on new investments in long-term assets than they receive from selling previous investments. There are direct and indirect methods to keep in mind. The basic idea of the direct method is to present the sales and expenses of a business on a cash basis. The idea of an indirect method is to start with net income and then adjust in order to reconcile cash flow. Variance between cash flow and net income. Keep in mind that the amount of cash flow from profit is usually different from profit itself due to both revenue and expenses. Cash paid out for operating costs is usually higher or lower than expenses booked for a given period. Here are some terms to keep in mind. Accounts receivable change. It shows how much money customers who bought products on credit owe a business. Inventory change. This hurts cash flow. Keeping the same inventory or not needing to make an inventory change, by contrast, helps cash flow. Prepaid expenses change. An increase in prepaid expenses hurts cash flow. A decrease helps cash flow. Depreciation. Real but non-cash expense. No cash outlay is made in recording depreciation of things like equipment. Changes in operating liabilities. An increase in short-term operating liability helps cash flow. The tax man. We've all heard that death and taxes are unavoidable in life. With a business, the goal is to find the right tax strategy that helps minimize your tax liabilities. Many sole proprietors file their business tax obligations as part of their 1040 tax returns using the Schedule C form. On this form, you'll report your company's income and expenses. You may serve as the bookkeeper for your business, meaning that you need to be meticulous and organized in writing down income, cost of goods sold, and expenses. Most businesses may benefit from hiring an accountant who can assist in recording all profits, losses, and assisting in finding ways to reduce the business's tax liability. If your business is structured as a partnership, it may not pay taxes, but instead split the money among the partners, who then pay personal income taxes. Paying corporate taxes. Here's what to remember. Reporting for an S corporation. An S corporation functions like a partnership, but gives owners more legal protection. Reporting for a C corporation. A C corporation is a legal entity that has been formed specifically for the purpose of running a business. Reporting for a limited liability company, LLC. These are now being used extensively in business with similar reporting requirements as other options. Taking care of sales tax obligations. Make sure you stay on top of the challenges of selling products in multiple states with different tax rules. In an online business, this is especially important as many of your customers may be out of state. Be sure to stay up to date on the latest updates in tax law. While most find it boring, your research may help you save money or avoid trouble. Some common ways you might want to do that include using IRS publications to learn about tax rules. There are resources that can explain the tax laws like you're just entering adulthood. Buying software to help you sift through all the complexity, for example, TurboTax. Accessing internet tax resources. Paying for tax help. It bears repeating, consider hiring accountants or experts in tax law to help you make sense of tax rules. You may have to spend more money up front, but it will save you a considerable amount in the long run. Now, let's test your knowledge with a few recap questions. Question: name a few key terms in bookkeeping. Potential answers include balance sheet, assets, equity, income statement, and revenue. Question: what is solvency? The ability of a business to pay its debts on time.